Happy Thursday, everybody, and welcome to session 6 of Schwab Coaching's New to Investing series. We made it 6 of 8. I'm Alex Coffey, and I'm a senior trading and derivative strategist for Charles Schwab. I'm also the host of Next Gen Investing on the Schwab Network. For those not familiar with Schwab Network, it is produced by Charles Schwab Media Productions, and it is a separate but affiliated subsidiary of Charles Schwab Corporation. Should also mention that today will be a moderated discussion for those who are catching us live on YouTube. My colleague Ben Watson will be in the chat to answer any questions that you may have. All right, so today is going to be a fun one. We're starting to put things together. Today's session is called Building Your First Portfolio. This is where we're going to start connecting some of the lessons from prior sessions together, go over some of the things that we've covered, and walk through what that action might ultimately look like. But before we get into the presentation, a few housekeeping items we must attend to here. So first off, today's discussion, it's for general informational and educational purposes only. Nothing we discuss today should be considered investment advice. And of course, investing involves risks, including the possible loss of the principal that would be invested, of course. And it's also important to remember, we talked about this last week, but we used the term diversification. We defined that. We walked through it a little bit yesterday. That doesn't actually ensure that you're going to avoid losses. So I just want to make sure we discuss that piece as well. Now, went too far here. What we'll look at here now is our series overview. So what we've done so far, we have 8 total sessions. We've gone through 5. We're on number 6 here. It's important to, I think, quickly remind those who are, been following along throughout this journey, or for maybe those who didn't get a chance to watch, lessons 1 through 5 just yet. And I should also note that they are archived on the Schwab Trader Talks YouTube channel. So this channel you're watching us on here in real time, there's a playlist available called New to Investing where you can see the previous lessons. So you can always go back, pause, rewind, and rewatch those as well. But so far we built from the basics. So we started by illustrating kind of the importance of this journey. And one of the main messages within lessons 1, which was the power of starting early, was this idea of compounding, which is a fancy way of basically talking about how investing, the whole idea behind it is the money you set aside and you accept a little bit of risk for has a chance to make more money. And then if that happens and it goes according to plan, that money can make more money. And so the idea of starting early allows that compounding journey to begin earlier, and that time, which is really one of the most important and most powerful things an investor can have, can really work for you. So we use the analogy of sort of envisioning a snowball gathering snow as you roll it down a snowy hill. What started as a relatively small ball can really balloon up into a much larger one. We went from there to sort of defining, what some of these different investment vehicles are, and notably the stock market being one of the most common ones. So we talked about the differences between investing and saving. Investing being that idea of taking a little bit of risk with the hopes of reward. Saving being more storage, setting aside, protective of that capital, not really expecting much in return, but knowing it's there in case a rainy day comes. From there, we started to introduce the Schwab.com web platform, which we'll spend much of today's lesson within as well. We started navigating and going through. So sessions 3 and 4, we went through some of the things that we'll go through relatively quickly today as we sort of start talking about that process in terms of how you would navigate the platform, one for idea generation, potential research and homework and pre-work for an investment, market, just trying to keep track of things, so market tracking. Then, of course, ultimately, how you would review the portfolio, how you would actually put in that investment to begin with. Then last week, we came back to the idea of, okay, you have this idea, you want to invest, but how should you structure that? And we introduced the idea of diversification, which is a fancy way of saying not to put your eggs all in one basket, or at least if you wanted to spread your risk around, that is a concept in investing that you can use to do that. As far as today's topic, though, we talked about, or I talked about how it's defined as building your first portfolio, and we're ultimately going to use that previous 5 sessions to build this example idea and sort of put these lessons together. And so one more important connection from last week is diversification isn't just about, having more assets or more things. It's really about understanding, what those things are, what role they play within the portfolio, and whether or not they're actually adding something different to that portfolio. So, if you chose 5 different names or companies, but they all worked in the same business, that's not really true diversification in the sense of changing the risk. They're going to have a lot of correlated, things about them. But we'll get into more about that in just a bit. So the agenda, we went through the series overview. Today we're going to keep it pretty practical, pretty high level. First, we'll quickly frame the decision between sort of the approach that someone may take to their investing journey. So one would be, this is something that you're doing for your future, but it's not your primary focus in life. And, that would be a more passive approach. So, when you do something like that, it's not set it and forget it, but it's also not dominating your day to day. And so when we discuss that, we'll talk about some concepts in a bit and some different things that can kind of make sense for that. Now, on the other side, active investing. Now, active investing doesn't necessarily mean trading. It doesn't necessarily mean multiple decisions on daily or weekly basis. It may just mean that rather than electing to buy something and potentially hold it for 10, 15, 20 years, you may define reasons for exiting at either a profit or loss. You may have, for example, maybe every quarter or every 3 months, you may revisit that portfolio and decide that you want to change it. And if your ideas change, you reserve the right to kind of go in. So an active approach can still be passive and investing focused, but it may have just a few more reasons and thoughts to go into that from both a risk management perspective and also an idea perspective. So most of the time that we'll spend today will actually be within the Schwab.com web platforms. We sort of go through all the things that we've done so far and work through building sort of a simple starter portfolio. One of the things that I think is important is when we're going through this, we're largely doing this conceptually, and there's many ways to do this. So there's not a specific one way or another to do it. But before we get into really discussing building a portfolio or using some of the lessons from before, I also think it's important to start with sort of that discussion around passive. And for many investors, new, particularly those that maybe have smaller accounts, in order to achieve what we discussed in the previous lesson 5, diversification, if you want to do this in a way that you're not spending a ton of time doing it, a broad-based fund, maybe one that tracks a major market index like the S&P 500, may ultimately provide more of that diversification with less headache. And that isn't to say that that's a better choice or makes sense for an individual, but it can be an option. So rather than trying to build a portfolio, 15, 20, or 30 different companies and trying to manage all of those and keep track of all of them, a single fund can offer a large exposure to a group of companies through just one single investment. So that is a really common way to start a portfolio and to build an investment portfolio. And there can be a combination of these things too. A large portion of it could be something tied to a broad-based fund, and then there can still be individual picks within that. But it can make sense to use some of those products if you're looking to do so with getting broader diversified exposure, but you don't necessarily want the headache of trying to manage and find all the individual ideas. But that said, being more broad doesn't necessarily mean perfect. And as we'll look at today when we pull up the platform, there are certainly days when the overall market can go down as well. And investors need to understand what those funds own, what they're concentrated in, or how concentrated are they. Each fund has different expenses, and understanding that can be important. And then ultimately you can start to answer the question about whether or not that fits your investment goal and fits in your portfolio. So to kind of summarize that, I guess for the passive side of things, a broader focused, a broader based fund, particularly one that tracks a major market index like the S&P 500 or the NASDAQ 100, that can be a reasonable starting point and starting concept for that type of portfolio. For a more maybe active investor, individual stocks can be used, but they require a little bit more research, a little bit more monitoring, and probably a little bit more discipline as well when you're discussing those. So let's start to pull up some examples here. So we're not ultimately going to look at any of those funds, so we'll keep that kind of part of the conversation more conceptual. But there are many popular passive equity funds that track those different indexes that we talked about. So it wouldn't be hard to find those if that is ultimately where you decided you want to go. But as we pull up the platform here, what I wanted to start with is just today's general performance, just to kind of put things in perspective. And I think this will really tie into next week's lesson as well, which is never think that investing doesn't come without risk. It absolutely does. And you can see today the markets were under pressure. And so investments in those marketplaces would have lost some of that capital today, at least on paper. So with that, NASDAQ was down 2%, S&P 500 was down 1.2%. To get to this screen, if you were following along at home, you can just go research, click US markets, and you'll get an idea of the screen that we're on. You can also see that over the last month, the markets have been a little bit more sideways than it had been. You can also see that it's starting to trend a little bit more neutral, where maybe if you were to look at this in April, it might have said it was trending a little bit more to the upside. Now, if we're discussing things from more of an active portfolio, or at least let's just say a portfolio that was built from a series of stocks as opposed from passive funds, let's suppose that we're building an example portfolio or a starter portfolio here today. Now, for those who have caught the other webcasts that we've done, we'll click our watch list here. You'll see we have our new to investing watch list here on the screen. And two of the companies that we've discussed throughout these lessons has been Apple as well as Nike. Now, both of these stocks were under pressure a bit here today, and depending on the name, they're in different relative ranges. So we can see on here, Nike was down almost 3%, and it's pretty close to its low over the last year. You can see that here where that 52-week range is. Where in the case of Apple, this is actually a stock that is much closer to its highs, but it did pull back just a bit here today. Now, let's say we wanted to ultimately bring this portfolio or this series of ideas to 5 names. So that's not going to be full diversification, but it's going to be more diversified than just one name or just 2 names. And so some of the names that I was thinking really fit this sort of mold of really recognizable names, and certainly they're not recommendations, but the reason I chose them is they're relatively straightforward. So they're products or services that we mostly understand, or maybe we interact with, or we've heard about. And so we have Apple, we have Nike. Those are pretty obvious ones. One's a consumer discretionary name in the case of Nike, really recognizable brand. The other is Apple, technology brand, and then of course the iPhone being a really popular product The other two that I wanted, or other three I wanted to add here are Delta Airlines, Netflix, and Eli Lilly. And the reason I chose these names, again, they're commonly known names, but they're also very different companies. So Delta Airlines is an airline. It's going to move for different reasons. Right now, it's very tied to the price of oil. Netflix, notably, actually was green today, despite the rest of the market being a little bit weaker. It's a really powerful content brand. And then Eli Lilly, a really big player within healthcare and pharmaceuticals, which maybe we don't think of Lilly, the brand, but you maybe think of some of those GLP-1 products or other names, and you're looking for an exposure that's different. A healthcare company can certainly provide that. So as you're doing this, a few kind of important questions that we should think about when we're building this is, am I spreading my exposure, my risk, or my investment across enough different areas of the economy? Am I relying too much on one company or one theme? Do these businesses respond to different things, or do they respond to the same things? If one's down, can others be up? And ultimately, the most important thing would be, does this fit the actual goal of my portfolio, my risk tolerance, and then my time horizon, which would be unique, of course, depending on who we are. But looking at these names, I mean, the first thing we can say is, yeah, they can certainly move in different directions because two of them were green, well, I guess Netflix just ever so slightly. Let's call Netflix unchanged, let's call Eli Lilly up, and let's call the other three down. So they certainly can move in different directions. So in that sense, they are achieving a little bit of, at least today, diversification. In order to answer some of the other questions, though, let's just go ahead and we'll click on Apple. We've used this as our discussion for much of the lessons throughout our journey here. We can start doing some of these different portfolio discussions and research items right here on the platform. So again, say we want to go through this, maybe we'd start with the company profile. We confirm it's the company we are looking for. It makes the iPhone. Maybe you want to see if there was any news, and you can see here, for example, Apple Maps is going to be integrated into Ford's universal electric vehicle platform. Maybe that's something that's exciting to you and it makes you excited about investing in Apple. And then ultimately we can look at the chart here. And this chart is a really powerful tool for many, as it can kind of give us, one, some tools for analysis, and many use technical analysis for their decision making. But for others, this is just a visual representation of how this stock has performed. And so we can see it's done quite nicely. It's started to pull back a little bit. Technical analysis, maybe look at some of these other levels here on this chart and say, oh, maybe that would be a level, if it does continue to go lower, that buyers would step in. And so all of these are useful sort of analytical tools and things that you can do to make that decision. Now, super unique. The process looks different for everybody. So I don't want to, illustrate too deeply, what a process would be, because I think it's important to kind of come to those conclusions on your own and ultimately make these decisions in what's your best interest in your mind. And so, say we wanted to look at those 5 names, though, and those were the names that we were discussing. So we can see them here on our watch list, and say we had, for example, I don't know, $2,500 in this account, and we wanted to actually go through. We can click this trade tab, go to the all-in-one trade ticket. You can see Apple there, so we can click that. We can go ahead and select buy, and say we want to do an equal amount in each one of these. So one of the nice things that's available on the Schwab.com web platform is that you can actually change this unit here to dollars. And so nice thing about 2,500 divided by 5, easy math. It's 500, so we can key in 500 there. And you can see that would be 1.5588 estimated amount of shares. But the nice thing we can also do here as well is that we can start pulling up second orders and kind of go through this for each of these ideas. Now, I know the symbols for the names that we're going to look at, so I can do that here. Click Nike, go to dollars again, buy, type in 500. Go ahead and do it again. Delta. And of course, you could do these all, one by one as well, but just kind of showing a cool feature here on the platform where we can go through, and I'm sure you kind of have got the point here, but we'll finish it out and go to buy dollars, 500, and then the final one here would be Eli Lilly from our discussion point. That's LLY, and go ahead and go to buy and 500. And so even if I minimize all of these, you can then see total estimated amount would be 2,500. You can see buy 500 of each of these different names. And so that's going to provide various quantities of each of them, but in total, it would be the same dollar figure for each of them. Now, for those who have followed along, they know there's not any money in this demo account. And of course, the demo account looks at times a little bit different than the live trading experience. But if you went ahead and you hit review order, you would actually pull up a confirmation for each of these. And it would, if you had the funding in the account, allow you ultimately, if this is what you wanted to do, go ahead and place the orders at the bottom. If they were filled, we go back to the top, we go to accounts, we can go to summary, and our account portfolio would pop up in terms of its total amount. And we could also go to positions, and we would see that here. So all in all, the key critical point here is there's no right or wrong way to build a portfolio. It's unique to everybody. But a couple critical things that I think are important is, one, to try to define as much of your goals and plans before you make the investment as you can. The reason I say that is it's easy to be swayed by emotions. It's easy to be swayed by the risk, especially on a day when the markets are lower. And suddenly, if you don't have a plan or a process, you may make a rash decision that you otherwise wouldn't have, just simply because of your emotional response to what's happening. And so that'll tie into our conversation next week, which is really around risks and the emotional traps that investors can sometimes fall into if they don't have a process and a plan laid out ahead of time. But thanks as always for tuning in, and we'll see you next week.